Hi, thanks so much for tuning in. You're watching BQ Prime, and this is an earnings conversation. We're speaking about Raymond's first quarter, and there's a lot to talk about outside of the operations. We'll get you all of those details. Joining us now to tell us more is Amit Agarwal, who's the Group CFO at Raymond. Thank you so much, Amit, for taking the time, and good morning to you. Let's start with the operations. Despite it being a seasonally weak quarter for the apparel business, or rather the lifestyle business, it's done better year on year. And from what I can see from the numbers that are reported, the weakness or the softness seems to be coming from the real estate business. But what, according to your internal estimates, has this quarter panned out as?
Thank you for having me on the show. And I think, look, as you pointed out, absolutely correct, that the consumer business, in spite of the weaker quarter seasonally, however, also we have to also acknowledge the fact that this was a subdued demand right from the January, February in this year. Because last year there was a very strong demand. Comparatively, we have seen a subdued demand. There are a few seasonal reasons. One, clearly there was some intermittent rain in the month of March, which gave an impact to the farmer community. Then you had a very excessive heat. And then in the north, early July, you had seen, mid-July, you had seen some very strong rains, which did not bring the customers to the shops. The second thing, what also happened was that there were lesser number of wedding days in this year. And in this quarter, that has also impacted. But in spite of that, if I look at it, we have done fairly well, especially on the branded apparel side. We have delivered more than 16% revenue growth and also expanded our EBITDA margin. Similarly, on the branded textile, you see the fabrics that reflects very clearly that with the wide reach which the company has and the product range which the company has been able to demonstrate also a growth in that business. Now, as far as the real estate is concerned, actually, we are not very surprised. We knew that the real estate, the revenue numbers would be lower because the concept of accounting revenues is based on percentage of completion method. Now, when you launch a project, and though you may have booked very well about that project, however, it takes at least 6 to 9 months before you actually are able to recognize the revenue because the construction and such things. So therefore, what has happened is, if you look at it, last year, our revenue recognition was much higher because we had launched the address by GS somewhere in November, and then we had got some months to work through. While this year, we launched our 10X era only end of February, so we did not have so much of time to work on this. Secondly, as the projects have been completed or have been at a higher booking stage and completion stage, we are launching new projects. Like we just launched a project in Thane, almost 1 million square feet with 2,000 crore of revenue potential. The beauty of that is that the day one, we were able to sell 50 units. Now, across the projects, our bookings have come very, very strong to the tune of 330 crores. So that very clearly reflects that it is just a accounting timing issue, but over the time, you would see that the revenues are catching up exactly in the same line, significantly higher compared to the last year.
Now, I'll come back to the operations, but another very key line item is the proceeds from the sale of that FMCG business, which quite substantially added to the bottom line and also gave you a cash surplus at the group level, right? So I'm just trying to understand, there's two aspects here. One, of course, the demerger of the lifestyle business and the listing thereof. What is the timeline and how do we see this proceeding, and how will you utilize that cash that is now sitting at the group level?
Sure. No, actually, we are very happy to do this transaction at FMCG. We sold this business at a very good value of 2,825 crores. Now, after paying tax, we are left with 2,200 crores. Now, based on this 2,200 crores, we said the lifestyle business would be demerged out of Raymond Limited and move into the Raymond Consumer Care Limited, where the cash sits. So the lifestyle business comes with almost 1,800 crore of debt, which knocks off the 2,200 crore, and then you are left with 450 crores of cash. Similarly, the other piece is in the real estate business, which is real estate and the Raymond corporate and the engineering business, which is sitting with almost like 1,000 crore of cash. Now, in terms of utilizing the cash, very simple, that we have charted out the growth plans for each of the businesses. First, let me talk about in the Raymond Lifestyle business. Raymond Lifestyle growth business does not require any significant capex. As we open 500 odd stores over the next 3 to 4 years, it is all franchisee led, so there's no capex requirement. I think, and all the other growth engines are basically based on a subcontracting so that we can do it. Except for the garmenting business, which is an export business, which we are benefiting because of China plus one. We are investing close to 200 crores in that area by expanding our capacity by almost a third, which will further enhance our revenue. And as we have seen consistently, if you see, our garmenting business has been delivering a stronger revenue growth as well as margin growth. The third piece of the capex which we want to do, we have underinvested into technology in the last few years in the lifestyle business. And I think we have a very clear plan to invest another 100 to 150 crores in the technology space. Plus, there is a cash flow generation. Now, coming to the real estate and the engineering business side, where the Raymond Limited is left, that business, you would see that we are doing the Thane land. And on top of it, we have also announced that we will be doing JDA projects. We have signed one JDA project, and we will be signing in the next few months another 2 or 3 JDA projects. So very clearly, the initial cost of putting the approval cost, not to pay any money for the land, but just for the approval cost, is something which we look forward to use that cash. Plus, we are in the process of also evaluating that what further room we have in terms of expansion. So very clearly, each of our businesses have chalked out a growth plan and will use that growth plan to deliver a very different group over the next 3 to 5 years.
So, correct me if I'm wrong, from the numbers that you've just spelled out, about 350 crore odd capex is what you're envisaging for the lifestyle businesses?
Absolutely.
And so what is the estimation for the real estate business?
So real estate, as I said, that look, we have done just now, if you talk about the Thane land, with Thane land, we have 100 acres, of which 40 acres, which is going to deliver 9,000 crore revenue, and the balance 60 acres is going to deliver another 16,000. So total Thane land potential is 25,000 crores. Plus, we are doing JDA project. So I think we have said that next 4 to 5 years, our revenue, which used to be 1,100 crore on the real estate business last year, we expect anything between 3,500 to 4,000 crores by a combination of our own land as well as the JDA route. We are not going to buy land at all. So there's no way this 1,000 crore is going to be used for any land acquisition. It is primarily for JDAs. But in the JDA, in the first 18 months, you need to deploy your capital, especially for a working capital, like approval cost, foundation, excavation, and so on and so forth. And I think that will be the one of the large use. Plus, we will continue to evaluate more opportunities.
Okay. Now, in terms of the timeline, you didn't spell that out. So you've announced that this demerger is in the works, but when do we see it getting executed?
Yeah, sorry about that. I think we should. So very clearly, we have already started the process of the demerger. We expect the approvals to be coming in a certain time frame manner. We believe that by end of March of next year, we should have the demerger done. However, let me explain that the demerger effective date is 1st April 2023. So you would have, let's say, next year at this juncture, 23-24 numbers of lifestyle as a pure play net debt free listed play, and the Raymond Limited will be pure play net debt free listed player with real estate and investments into engineering.
Which is why you very clearly demarcated, I think, in your investor presentation, how it would look as the lifestyle business. I was looking at the working capital, and you mentioned that part of that is to do with the real estate business and what you're doing right now, but it is quite elevated as things stand right now, 79 days right now, and that I think is the highest that it has been in quite a while. Is that likely to continue to be the case, Amit, for the foreseeable future, for this financial year at least?
No, actually, it is not an elevated level at the highest, because you see, we used to have pre-pandemic more than 110 days. And especially, so that has come down. However, our targets are much lower. Because you see, fundamentally, the 2 or 3 major dramatic change we have made in the receivable cycle and the inventory cycle, which has brought us the change. So we were, like say, last year, March, we were sub 55 days. So I think that is fundamental change which we have brought. Now, when you have this quarter is meant to produce and keep it the inventory for the dealer network. Because as we expect, October and November, very, very strong season. You can't produce everything at that point of time. So therefore, what you need to do is produce it, stock it well in order to cater to the demands. And fabrics is such thing that you don't have only 50 or 100 SKUs. You're talking about 5,000 SKUs because you have a different color, shade, pattern, and similar is in the apparel side. So therefore, what you need to do is, because we run our manufacturing facilities, we plan the manufacturing in such a manner that everything does not get clouded exactly at the same point of time, so that you can service the market appropriately. So therefore, this is a known fact. If you look at it consistently over the last so many years, the June and September, the inventory and receivables go up. And in the second half of the period, the working capital comes down, because then you see a big sales happening, and then you get the cash and you reduce your inventory.
Okay, thanks so much for that clarification. Leave us with the last leg, which is you spoke about the demand scenario in the first half of the year getting impacted by unseasonal weather situations. I'm also curious about the cost side and the input side and how you're seeing that pan out in the remainder of the financial year, and thereby give us an idea as to how margins will pan out. I understand that the first quarter is generally a little subdued, but do you see it picking up, and how do you see it moving?
Yeah, so actually, if you see, you asked 3 questions basically. One is a demand. We seem to be quite bullish on the demand because 8-9 months period, the retail has been lull. And since 8-9 months retail has been lull, you would see the discretionary spending coming back. With especially the triggers are clearly the Durga Puja, the Shera, Diwali, and the onset of the wedding season. Because some of the rural weddings have also shifted from a summer to winter, and winter has been normally a very, very strong wedding season. You go and talk to any hotelier, I think today you will not find a room, especially in that. So that's number one. Second thing, you asked about the margin. If you see the margin, compared to last year, we have delivered a better margin. But when your sales are low in the first quarter because of seasonally weak quarter, you would see a better margin because everything inventory is at a cost of goods sold, and when you sell it, you realize the margin. So actually what happens in the second half of the year, we always get a better margin. If you see last year, previous year, always it has been the same case. So we are very clear that our margins are going to improve in the second half of the year. And as we delivered in the last year, what the margins, we should be able to deliver comfortably those margins, but at a higher revenue level.
And therefore, finally, you're comfortable the input costs are benign. That was the last aspect that I wanted to touch on.
Input cost, as I had told you earlier, that for example, wool has been fairly consistent, so there has not been much of a change. As far as the cotton is concerned, in our shirting fabric, what you really need is 200 grams per meter of a cotton, of the shirting fabric. So to that extent, the variability does not make a lot of difference, though we have to also make certain corrections in the demand, in the pricing. But because we are so much retail-led business, we don't have to make the corrections in every month or every quarter. So there is a gradual change which we have taken in the increase side as well as on the decrease side. So we do not see any major change in the margin pattern.
Fantastic.
Because of the
Fantastic. Okay. I think we've had a very wide-ranging conversation, and thank you so much, Amit, for your patience. Pleasure speaking with you on BQ Prime.
Thank you.
Thank you.
Look forward.